Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Tesla continues to cut prices. We got news this week that the Model S and Model X were getting price cuts in the US of about $5,000. This continues about 6 months now of price cuts that started in December. That's certainly hurting Tesla's margins, but the bigger impact may be on some of its EV competitors, the companies that are trying to ramp up production, companies like Rivian. I want to look at the potential impact in this video. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And I want to start with this chart that shows exactly how much Tesla has been cutting its prices already. You can see that in the second quarter of 2022, the average Tesla sold for $57,331. A year later, Q1 2023, the average price was $47,207. On top of this quarter, which would be Q2 2023, prices have come down even further. So it's likely that over the past year, Tesla has cut the average price for its vehicle, the blended price, by in excess of $10,000 or about 10%. So how does that impact a company like Rivian? Well, if you're looking for an electric vehicle, there are still only a handful of options, and especially if you're looking for one of the companies that's only making electric vehicles. Rivian is one of the hotter startups, but it's got to be pretty compelling to look at a Tesla if you are looking at the price of these vehicles. Rivian's still going to be in excess of about $75,000 or $80,000 for any vehicle, and you can get in a Tesla today for under $40,000 before tax credits. The actual impact on Rivian is starting to be seen in demand. If we go back to Q3 2022, Rivian used to report the backlog that it had, the number of orders that it had for vehicles for future delivery. And at that time, there was years worth of orders. But over the last few months, we've started to see signs that there's simply not as many orders as we thought. That's partially because people could cancel their order to get their $1,000 back. That's actually what I did. This was the first sign here. There was some announcements a couple of weeks ago that you could get a Rivian R1 truck, a Rivian R1T in less than 14 days. Now, I did a video about this and got a lot of pushback that this was one specific model and there was still plenty of backlog for some of their other models. In part, that is true, but this has been expanded now in the future. If you look at the R1T site and go into reserve, you can see that available configurations could be delivered in 14 days or less. Custom configurations are still delivered in 4 to 16 weeks, so under 4 months. That's for a custom configuration for an R1T. On the R1S side, you're still looking at a delivery in 2024 sometime. So reading the tea leaves there's not enough demand for what Rivian is producing on the R1T side. And remember that they're only planning on producing about 50,000 vehicles this year. So that's a very, very small production base. One of the challenges that Rivian has in the current economic environment is that expensive vehicles have gotten even more expensive as interest rates have risen. That's caused a lot of people to trade down to less expensive vehicles. We've seen this at Tesla with demand for the Model S and Model X dropping, but there's still a lot of demand for Model 3 and Model Y. That's the lower price vehicles. This is something you're seeing across the board in the auto industry. The problem for Rivian is they only make those expensive vehicles. They only make $75,000 trucks, $80,000 SUVs. There's nothing that somebody could trade down to. So the only option that you have if you're a pending customer is just to cancel your order and look for something else. It's an anecdote, but that's exactly what we did. So from an investment standpoint, what I'm seeing is that demand for Rivian's vehicles at the price point they're at today is simply not as strong as we would like to see as an investor. Tesla, as a much bigger auto producer, is going to have to deal with those impacts on demand changes much more quickly. So if they want to increase production, which is their goal to increase production 50% a year, they're going to have to do something like lower prices to increase demand. Rivian is also quickly ramping up its production. It hasn't gotten to the point yet where it's building up inventory. And that's partially because it's building a very relatively small base of vehicles. But it is planning to double production this year, and I would expect production to about double in 2024 as well. The question is demand going to double? Because right now at the 50,000 unit production level, Rivian is not profitable, not generating free cash flow. It's not a sustainable business. The company needs to get to the point where it's making 3, 4, 500,000 vehicles. It needs to build another plant. It needs to get the R2 line out. But if there isn't enough demand for every single R1 vehicle that it can make right now, that is a problem. It's a problem early in Rivian's history. I haven't sold my shares of Rivian yet, but it's something that I'm very much considering, and this is the reason why. So what do you think about Rivian's demand right now and the price pressure in the EV market? Love to hear your comments in the comment section below. Thanks for watching, everybody. See you here next time.